Hello, I'm Tony Cordato. I'm a real estate lawyer. That means I look after property transactions such as buying and selling, mortgages, leases, strata title, and my favourite, vendor finance. This talk is all about carryback loans, and it's one of a series of explainers under the heading The Keys to Vendor Finance for Real Estate in Australia. Carryback loans are probably the most useful form of vendor finance around. The reason is that they fill gaps. A purchaser may have a 10% deposit and a bank that's willing to lend 80%. Purchaser has a problem. They've got a gap of 10%. Some purchasers are able to call upon the bank of mum and dad for a family loan for that 10%. Other purchasers are not so lucky. When a vendor is in the situation where the purchaser has the deposit and a bank loan but needs a 10% gap loan or deposit loan, what does a smart vendor do? They offer carryback finance. They offer to fund that 10%. Now, they're not banks. They're not going to give a 30-year loan, but they must give a loan that's affordable to repay. And what that means is a loan of 2, 3, 4 or 5 years where the purchaser repays at least interest and some of the principal and makes a balloon payment at the end. That is a carryback loan. And what a carryback loan does is enables the vendor to sell the property at the price they want now because they have a purchaser ready to buy. Certain properties where carryback loans are pretty much essential if a vendor really wants to sell a property. And they are loans where postcode limit applies. What's a postcode limit? Well, many banks will limit their loans to 65%, 70% or 80% of valuations if the property is in a regional town, particularly if there's less than 2,000 people. Or it's for a regional property, a hobby farm. Or even in the inner city, in high-rise apartment blocks, banks will limit the percentage of the price that they lend. And of course, commercial properties where many banks will lend only 65%, 70% or 80%. If you're selling a commercial property, this may be the difference between a sale and having it on the market for another few months. Can I give an example? $450,000 property. Could be a regional apartment, could be a regional house. The purchaser has 10%, $45,000. That means there's $405,000 to go. But if you have one of these bank loans which are limited to 80%, the purchaser is going to be $45,000 short. So what do? You tell the buyer, I'm happy to give you a carryback loan. Now you'll be paying interest. Actually, some vendors don't even charge interest. They say, well, just give me $200 a week off the loan and I'll be happy. Why? Because the vendor's getting the price they want. They don't have to discount the price of the property to sell it. And of course, after 2, 3, 4, 5 years, Whatever's left of the loan will be payable as a balloon payment. Now the purchaser has to know where they're going to get that money from. Often they'll be refinancing. Purchaser will know from having talked to their bank or mortgage broker that they can actually afford that balloon payment in a couple of years' time. Now, the vendor has to have security for that loan because the title to the property transfers to the purchaser when the balance price is paid. And that security will be in the form of a loan agreement and a mortgage. The mortgage can be registered on the title with the permission of the lender who has the first mortgage, or you can simply register a caveat over the title, which means that the purchaser cannot borrow from anyone else or sell the property without paying back the carryback loan. Now, carryback loans are easy, aren't they? And you wonder why everyone doesn't use one to sell the property at the price they want. The other situation for carryback loans is in a delayed settlement situation. Can I give you an example? So, hello Sue. Can we talk about a carryback loan that you've just completed to settle a property purchase?
Absolutely, Tony. So what happened was with the same property, here comes the time of the settlement. And at the settlement, because the valuation everywhere went down because of the interest rate, there was a shortage of $200,000 funds to settle on this particular property. So we went back to the agent and explained him that look, we need more time to fund this money, or they negotiate the contract price, or we can do 90%. We settle on whatever the valuation is, banks funding and everything, and then we carry back, or we get $200,000 as a loan from the vendor, and we can pay them in 6 months' time.
Now, so the agent then spoke to the vendors. Were the vendors happy with that?
It was not a straight line. It was not in a straight line. So what happened was when we went back to agent and with all these options, the vendor came back saying, nope, we are not agreeing to any of that until just the day before of the settlement, when they realized that it's worth to have this settlement at 90%, and then it's worth to give the owner the time, the new purchaser the time, or us the time to be able to for them to get the maximum money out of the settlement, and they were happy to wait for the rest.
Yeah, so they're happy to accept most of the price on the settlement to get it settled.
To get it settled, yes.
And then the $200,000 later.
Later, absolutely.
So how much later?
It was 6 months' time that they agreed to.
And you're going to be paying interest on that?
We are going to be paying interest on that, but it is not kind of interest that you pay to the banks on a monthly basis. We are going to pay them along with the principal in 6 months' time.
At the end of the 6 months.
At the end of the term.
So you've got the keys to the property.
We've got the keys to the property, and now we are earning that rent.
Oh, it's rented, so actually got something to pay the mortgage with.
Yes.
So, so in the end, everyone was happy with that arrangement, weren't they?
This was an absolute win-win situation. Like we name it for this deal. We wanted time before settlement. We wanted to pay low deposit. We wanted to do the DA approvals. We wanted to, at the end of even at the settlement where there was a shortfall of the funds, we got the vendor finance. Like what more can you ask for? Like this is an amazing deal where people can leverage on these other options if they are shortage, rather than walking out of the deals.
Well, and to walk out of the deal, you have a fight because they want to keep all the deposits, and they may want to enforce the contract if the value of the property's gone down. It's a complete mess.
Yeah.
All right. Well, thanks for sharing the story, Sue. That was
Thank you very
wonderful.
much, Tony. Thank you.
Okay. There's another situation where a carryback loan is really useful, and that is when the house is damaged by fire, by flood, or by termites. No bank will lend a full loan for a damaged house. They'll hold back. So if you have a damaged house to sell, you can, of course, fix it yourself, or you can sell it. But you sell it with a carryback loan, you'll make it very easy to sell. For two reasons. The purchaser will pay you the 10% deposit and will pay you whatever loan the bank will give them. And that's 65%, 70%, or even 80%. And the difference is your carryback loan. Now you work out how long it's going to take for the purchaser to renovate the house. 6 months, maybe even 12 months. And you say, I want that carryback loan paid to me in 12 months' time. Where's the purchaser going to get that money? Well, instead of paying the vendor the whole price and having no money left over to renovate the house, because they're only paying 75%, 80%, or 90% of the price, they have money left over, the carryback loan money, which they can use to do the renovation. The house improves in value because it is renovated, and they will have no trouble at the end of 12 months to borrow enough money to pay you out the carryback loan because they've improved the equity in the property. Problem solved for a damaged house. Now there are some rules around carryback loans. You should always have the purchaser qualified by a mortgage broker as being able to refinance in 12 months' time if the property is renovated. Refinance the carryback loan. The other thing is that if you're selling with a carryback loan and you do it once, yes, you're providing credit, but you're not in the business of providing credit. And so you don't need an Australian credit licence. You could probably do this 2 or 3 times as part of selling a property, because your main purpose is to sell the property. The carryback loan is a means of sale. But if you do it more regularly or start offering it more regularly, then you will need an Australian credit licence or need to team up with someone who has an Australian credit licence to do the lending. Well, that's all for carryback loans for the time being. If you want more information, go to my website www.vendorfinancelawyer.com.au.